Hello and welcome to our question answer sessions on accounting. In these sessions, I'll try to answer some of your questions. You're most welcome to send your questions by mail, or you can also upload your questions on my ebook, or you can also use the Facebook or YouTube channel and put your questions there. Today's first question is how different is dividend from interest? Dividend is a distribution of profit, whereas interest is an expense. Dividend is not compulsory or mandatory, whereas interest a company has to pay whether the company has profits or no profits. Even if there is profit, the management may decide not to distribute the dividend. So the dividend is appropriation, whereas interest is an expense. Dividend is below the line item, whereas interest is above the line item. The second question: what is book value per share? Book value per share is a dividend, is the equity of the company divided by number of shares. Book value per share shows the asset backup per share. The book value is useful to understand that if the company is dissolved now and if the assets fetch the same value as shown on the balance sheet, then the shareholders will get the market value of the assets minus the liabilities, and whatever money available will be distributed among the shareholders. So the book value per share is also called the asset backup per share. Let us take the next question. The next question is, what are preference shares? Preference shares are a type of shares which have preference over the common shares or equity shares with respect to return on capital and return of capital. If the company has to distribute the dividend, then the preference shareholders will get the dividend first or before the equity shareholders. So they have preference over the equity shareholders regarding or with respect to the dividend. Similarly, if the company dissolves or liquidated after meeting the liabilities, the available cash will be given to the preference shareholders, and then if any money available, it will be given to the equity shareholders. So that is why they are called preference shares. Now let's go to the next one. The next question is, what is stock dividend? Stock dividend is a distribution of profit in the form of shares. Sometimes companies may be having huge reserves but no cash, so then the company would like to distribute the dividend but not in the form of cash by issuing the shares. So therefore stock dividend is also known as capitalization of reserves. So when a company declares stock dividend, the reserves available for distribution are converted to the capital. The stock dividend is the appropriation or distribution of dividend in the form of shares. The next questions. Is stock dividend same as the stock split? The answer is no. Stock dividend is a distribution of profit in the form of shares, whereas stock split is change in the denomination of the shares. Stock split is reducing the face value per share. So when a face value of share is reduced, the number of shares goes up. Therefore, it is said to be shares have been splitted. So stock split is a process of changing or reducing the denomination of the face value per share. The stock split will not change the equity, will not change the capital, but will change the number of shares. Therefore, all other things remaining constant, the book value per share falls due to the stock split. In case of stock dividend also, the book value per share falls, but here it is book value is reducing because the profit is distributed, profit is converted to the capital, so capital goes up. In stock split, capital remains same. So stock split is changing the denomination of the shares, whereas stock dividend is a distribution of dividend in the form of shares. So these were some of the questions that I received from you which relate to the capital. In one of our sessions, we will try to pick up these questions and understand the effect on the financial statements. But please continue to send your questions and I'll try to answer them as and when possible. Thank you very much.